Hello, everyone. When we talk about credit, you might immediately think of everyday ideas like keeping one's word or honoring commitments. However, in finance, credit has a more precise meaning, and it is not static. Instead, it evolves continuously alongside social and economic development. Today, we will explore the meaning and evolution of credit, helping you understand what credit really is and how it has developed step by step to its current form. In this lesson, we will cover two main topics. 1. Meaning of credit, the movement of value based on trust. 2. Evolution of credit, its development from simple forms to complex systems. 1. Meaning of credit, the movement of value based on trust. In finance, the core meaning of credit can be summarized as a lending activity conditioned on repayment and interest payment. Simply put, one party, the creditor, temporarily transfers money or goods to another party, the debtor, trusting that the debtor will repay the principal at the agreed time and also pay a certain amount of interest. For example, when a company applies for a bank loan, the bank approves and lends the funds to the company. The company then promises to repay the loan with interest over several years. This is a typical credit transaction. There are three key elements here. 1. Lending relationship. There must be a transfer of money or goods from the lender to the borrower. 2. Repayment commitment. The debtor must ensure that the principal is repaid by the agreed date. 3. Interest payment. In addition to the principal, the debtor usually pays extra as compensation. This is the creditor's return for temporarily allowing the use of their funds. It is important to note that credit is different from ordinary gifts or aid. Its essence lies in a one-way transfer of value, but this transfer is conditional. It must be repaid along with interest. 2. Evolution of credit, its development from simple forms to complex systems. Credit did not appear out of nowhere. It has developed alongside human economic activities and can roughly be divided into three stages. 1. Primitive credit, simple lending based on kinship and local ties. In primitive societies and the early feudal period, credit existed mainly among people who knew each other, such as relatives, neighbors, or villagers. At that time, there was no unified currency. Lending usually involved physical goods like grain or tools, and formal written agreements were rare. Repayment largely relied on personal relationships and moral obligations. For example, farmers borrowed a few bushels of seed from neighbors during the planting season, promising to return a larger amount after the harvest. Small craftsmen, lacking funds to buy raw materials, borrowed money from relatives with an agreement to repay after earning income. Characteristics of primitive credit: limited in scope, simple in form, dependent on personal relationships, and difficult to operate beyond familiar circles. 2. Traditional credit, commercial lending with money. With the emergence of money and the development of the commodity economy, credit began to extend beyond familiar circles into the commercial sector. At this stage, credit mainly took the form of monetary lending, and specialized lending institutions appeared, such as ancient Chinese money shops, draft banks, and early banks in Europe. For example, a merchant needing funds for long-distance trade might borrow from a money shop, agreeing to repay with interest upon return. The money shop would collect deposits from wealthy individuals and lend to merchants, earning a profit from the interest differential. In this stage, credit underwent two important changes. 1. Upgraded medium. It shifted from primarily lending physical goods to primarily lending money. 2. Emergence of institutions. Specialized financial institutions became intermediaries of credit, making lending more standardized. However, the scale of credit was still limited, mainly serving commercial activities, and ordinary people had little access to it. 3. Modern credit, a systematized social credit network. Since the Industrial Revolution, and especially from the 20th century onward, credit has entered the modern stage, forming a comprehensive and systematic network. Modern credit extends far beyond bank loans. It now includes credit cards, consumer loans, corporate bonds, government bonds, and other forms. Moreover, professional credit evaluation agencies, e.g., credit reporting companies, exist to record and assess the creditworthiness of individuals and businesses. For example, when we use a credit card, the bank pays on our behalf first, and we repay by the due date. This is a form of short-term credit. When a company issues bonds to raise funds and promises to repay principal with interest at maturity, this is corporate credit. When a government issues treasury bonds to borrow money from the public for infrastructure or other projects, this is sovereign credit. The characteristics of modern credit are wide scope, diverse forms, and reliance on institutions and technology. Individuals, businesses, and governments can all participate in credit activities, and credit no longer depends solely on personal relationships but is ensured through contracts, laws, and credit records. Today, we studied the meaning and evolution of credit. The core of credit is a lending activity conditioned on repayment and interest payment. Its evolution has gone through 3 stages: lending of physical goods among familiar people in primitive society, commercial monetary lending in traditional society, and a systematized credit network in modern society. The development of credit reflects economic progress, from simple mutual help to complex financial activities. Credit allows funds and resources to flow more smoothly, making life more convenient. For instance, without credit, it would be difficult to purchase a house or a car in advance, and companies would struggle to expand production quickly. That concludes our lesson on the meaning and evolution of credit.